I just wanted to reflect for a moment on the financial crisis, which is not the topic of my paper, but I think there's an incredible risk with big events like this, with events like the financial crisis, that they just fade from memory. You can see this in the academic research community, where there was this flurry of activity right after the crisis, where all of a sudden the plumbing of the financial system became something that everyone was interested in. All of a sudden, intermediation and banking, which had faded from research for many years, was a hot topic. And already you see kind of that wave of research kind of disappearing and people moving on to the next thing. And I think in preparation partly for this event and in general just to kind of think about the events that happened 10 years ago, I've been rereading some of the books that came out, and I would encourage all of you to do so. In fact, I was reading this morning the Tim Geithner's biography, Stress Test, which is an incredible book. And I wanted to read, just before I jump into the presentation, a short passage that I just really resonated with me. He describes crisis like war. And he says, as he's describing it, he says, it's the overwhelming burden of responsibility combined with the paralyzing risk of catastrophic failure, the frustration about the stuff out of your control, the knowledge that even good decisions might turn out badly. And I think if we all put ourselves 10 years back, you can kind of remember how bad it was. But sitting here in a very comfortable surroundings today, it's so easy to forget. And I guess I would just encourage you guys to think about doing events like this. Do the 20-year, do the 25-year, because as these things fade from memory, that's when it's really important to keep these lessons alive. All right, so that's enough preaching for me. This is work with Andre Schleifer and Yang Yu. Yang Yu is a graduate student at Harvard. And I was thinking about the title of this paper today. Actually, with Bob Schiller here, I thought maybe a more appropriate title would have been Fama versus Schiller, because that's kind of also what this paper is about. Now, for those of you who are practitioners, you may not know this, but in the academic community, bubble is, it's actually a 6-letter word, but it feels like a 4-letter word. And it feels like a 4-letter word because, in fact, in my own papers, sometimes I'll use the word bubble, and then I will go through the paper afterwards with a word search to make sure I do a search and replace and get rid of it, because I'm sure that it will be rejected from the journals as a result. So why is the term bubble such a contentious word? It's contentious because it's easy after the fact, ex post, to describe something as a bubble. And in fact, we all know these incredible historical narratives, like books about .com, books about the Roaring '20s, and so on, that describe this episode of rapid price appreciation followed by a dramatic crash. Now, financial economists would say there's nothing more to that than just storytelling. Actually, and Bob Schiller today was using the word narrative economics. There's a lot of just narrative economics there. So financial economists would say, it's fine to call something like that after the fact, but can you say anything ex ante? Can you say anything before the fact, before the prices have actually crashed, that you can actually characterize a particular period as being a bubble? And that's really what this paper is about. And it may surprise you, the question that we're going to ask today, which is, what are the circumstances under which empirically you might call a bubble? You'd think, well, that would be a topic that lots of people have worked on over the years in finance. And while that's true to some extent, people have thought about that in the context of the overall market. And in fact, the debate we had today with Schiller and Siegel was very much along those lines. But actually, beyond the market level work, there's been very little work trying to think about that question. And so we're going to try to jump in there and see what we can say with the data. So why is it bubbles for Fama? I think because Gene Fama best kind of personifies this objection to the term bubble. Okay? And most famously, this is a quote of his. He says, for bubbles, I want a systematic way of identifying them. It's a simple proposition. You have to be able to predict that there's some end to it. All the tests people have done trying to do that don't work. Statistically, people have not come up with ways of identifying bubbles. Fama takes issue with Schiller's definition of bubbles, and he calls Bob to the task and says, when you look at episodes, for example, like what people called the real estate bubble, or like even .com, was it really a bubble? What were the returns experienced by investors? Could we have called that in advance? Now, Fama's conclusion that there's no such thing as a bubble is obviously at odds with an enormous historical literature on this topic. I mean, just think of Kindleberger and, of course, Schiller's famous book, Irrational Exuberance. So what are we going to do? We're going to look at the evidence. So we look at all episodes since 1928 in which stock prices of a US industry have increased over 100% in raw and net of market returns. So we're basically looking at enormous price run-ups. And we're going to look at industries, and I'll explain why in a moment. But basically, think of most of the bubbles that you can remember, things like .com, they do have this strong industry component to them. We're going to identify 40 episodes like that in the US data, so really not very much. We're not going to have a lot of statistical power. So I like to say I work at Harvard Business School at HBS. We're pioneers of the case method. Well, the case method is N=1 research. And so we're going to be sort of in between the traditional large sample research and the N=1 HBS style here with 40 episodes. So using these episodes, we're going to look at average returns, the likelihood of a crash after the run-up, whether other features of the price run-up can help forecast a crash, and in doing so help an investor earn abnormal returns from timing the bubble. So what do I mean by that? I mean, can you look at other things that are happening during the price run-up? Is there a lot of turnover, issuance? Are people talking about the industry a lot? All that type of thing. Now, some of that's going to be hard to quantify, and basically what we're trying to do here is measure speculative activity in some way and ask whether that's going to help you call something a bubble. Then we repeat all of this analysis on international data. The international data that we have covers a large number of countries, but it only goes back to the 1980s. So it's not going to be as historical, have as much historical depth as the US analysis, but it's still going to have something to add here. So what do we find? So first, Fama is right about average returns in a way that I'm going to make precise, which is to say that average returns post-run-up are actually modestly positive. Basically, it's very hard to look at the averages and to say there's such a thing as a bubble. Okay? However, excess returns are mediocre after the price run-ups, meaning net of risk-free rate returns. They're certainly very risky, and the returns they're sort of mediocre at best, and so the Sharpe ratios don't look terrific. Having said that, our second finding, I think, is the more interesting one. High past returns are associated with a dramatically higher probability of a crash. What does that mean? It means that when the prices have run up, basically, looking forward, you're sitting on a coin flip. Either things are going to go extremely badly, or things are going to continue to do quite well. And that's what gives you that average of kind of mediocre performance. If you increase the past return threshold, the probability of a crash increases even more. Now, what explains the difference between the first and the second finding? Well, of course, some industries just keep going up, and peaks are hard to tell. So even if you were to call the peak, even if you were to kind of know history in advance and know which of the industries are going to crash, on average, the prices are going to peak 5.5 months after we first identify the run-up. So it's going to be very hard to get the timing right, even if you were to know history in advance. Okay? Third finding, there are differences in characteristics between the price run-ups that crash and the price run-ups that don't. Now, this is a challenging historical exercise because we have to collect data on the nature of the price run-up, so what was happening at the time. And so we have to be able to compare, for example, a price run-up in utilities in 1929 with a price run-up in .com stocks in 1999. What are other features of the data at that time? It's hard to do that kind of analysis and kind of keep the units right. Okay, all of that said, we look at turnover, volatility, issuance, book to market, age, market P, and the price path. And for many of these characteristics, we show that there are pretty significant differences between crashes and non-crashes, meaning that these are going to help you tease apart which of the episodes are going to crash versus the ones that don't. Now, I don't want to claim that this is a very high R-squared endeavor. So it's helping you at the margin call these events. But again, there's limited power here. And I think this is kind of tilting you to being able to call a bubble versus not. Fourth, and I think the fourth one you could have predicted from the third, but it is actually somewhat distinct. These characteristics can be used to time the bubble in the sense that they predict returns. So the same characteristics in conjunction with the price increase predict low returns over a 2-year horizon. So changes in volatility, issuance, acceleration. So acceleration is a variable that measures whether the price goes up like this or whether the price kind of just goes up smoothly. Second derivative, sure. You must be the math guy. Physics, okay. Overall, basically, Fama is right in a very narrow sense that it's hard to call a bubble. But I think if you take a broader view of the question, we think this kind of helps you say, well, there's a possibility of calling a bubble, in the sense that you can predict an end to it. One more additional observation. We tend to find stronger evidence of forecasting net of risk-free performance than net of market performance. And our interpretation here is that industry bubbles tend to occur during periods of high-priced markets. That kind of rings true if you kind of think through your kind of bubble history, right? Like the late 1920s were about radio and telecom stocks, right? It was a particular industries that were really fired up. But of course, there were industries during the 1920s, for example, railroads, that were not doing that well. And similarly, during the 1990s, value stocks, late 1990s, value stocks were doing poorly. We can study industry returns. Industries we're going to define using the Fama and French classification. So we're only going to consider industries with 10 firms or more. Yeah, you could do this analysis at the firm level if you wanted to. And in fact, recently there's some work trying to do that. Kent Daniel has a nice paper. It has a slightly different spin on all of this, but it's related in theme. We're going to require that over the past 2 years, there's 100% or more raw return and 100% net of market return. Okay, there are not a lot of events like this. This is a pretty dramatic price run-up. And we're going to require also that over the past 5 years, there's 100% or more raw return. So why do we add that additional screen? It's so that we're not picking up recoveries. So for example, post-crash, some industries just recover over the next year from the crash. I don't think people would conventionally call that a bubble, and so we just didn't want to have that in our set of analysis. These criteria are going to give you 40 episodes in the US data. In the international data, we're going to basically use the identical criteria, but we don't have the Fama French industries. We're going to use GICS sectors, which is very familiar to people in the room. So a few nits about the data. We do include newly listed firms, so the portfolios are not fixed on a calendar year basis. What does that mean? It means when new firms come into the sample, we do track them. It's kind of actually pretty important for a lot of these industries because a lot of these bubble type industries actually have a lot of new lists coming in. And so you want to make sure to track them. That's actually quite different from the way that the Fama and French industry portfolios are computed because they fix the portfolios at the beginning of the year. So they leave out a lot of actually these really interesting firms. Another thing that you might worry about is that the industry definitions we use, this is especially if you're a quant in the room, are quite narrow. So for example, what people generically call .com actually included a couple of different industries. And so those are going to appear as separate in our data. So you might think of these as obviously not completely distinct. They're sort of related to the same phenomena. Okay, so let me just show you a couple of examples of what we have in the data. This is just a very familiar one. This is software. So we first picked that up. Remember, we're screening on a very high price run-up. We picked that up first in March of 1999. You can see here time 0 is when we first hit the price run-up. You can see that's not even close to the peak price, right? It takes another year before prices peak in the spring of 2000. Here's another one. This is electrical equipment in 1929. So we first picked that up in January of 1929. Here, as you know, the prices fell in the fall of 1929. And you can see that we were a little early, but not quite as early as on the .com. Now, these, of course, these are episodes that you're familiar with. There's also a bunch of stuff that you're not familiar with. Why? They're the bubbles that weren't. They're price run-ups that never crashed. Here's an example, software in 1992. So actually a pretty dramatic price run-up in the early 1990s, and then it just continued. Healthcare, early 1980s, same type of story. Now, you might say, well, geez, Robin, you guys should go out longer. And I call this the Jeremy Grantham critique, which is to say that Jeremy Grantham never met a time series that he didn't like to call a bubble, but he, of course, gives himself 10 years to identify it. We're going to basically try to be strict on ourselves and say we're going to track the price action over the next 2 years and see what happens then. International data, we're using all of the stocks in CompuStat Express feed. We identified basically the same methodology. We get 107 price run-ups in total, 31 countries. Basically exact same statistics we get in the international data. So 53 of these end up in a crash and 54 do not. Okay, so here's the average. This is the Fama is right point. So if you look first at the dotted line, so let me explain this picture. So first, look up at the price rise. All of those series run up. That's just saying that we're conditioning on the prices having run up a lot relative to the market, which is shown as that blue dotted line there. Okay? Now, what's the average return? It's that black dashed line right there, which is to say on average, prices are flat. However, about half of the episodes end up in a crash, which we define as a 40% drawdown or more within the next 2 years. And the rest, obviously, kind of by construction end up as a non-crash. That's the only way you can get that average return being kind of flat. Now, you could say, of course, it's kind of cheating because you can separate any series that goes like this into those that went up and those that went down. I think what I'm going to show you that's dramatic about this picture is just kind of how widely distributed these outcomes are relative to prior history. So here are the average returns. I'll draw your attention to the ones that are in yellow there. The average net of risk-free rate return over the next 12 months is 3%. The average 24-month return is minus 10%. Okay, all of that is to say is you're sitting on not a disaster, but you're looking at average returns that are kind of mediocre. Of course, these turn out to be quite risky, so the Sharpe ratios are not awesome. This is another, I think, interesting point here is even in the cases where we correctly identify the run-up, as I said, you have about 5 months before the industry hits peak price. Okay, so it's very hard to call the timing on these things. During these 5 months, the average return is 30% until it hits peak price, so you better have some dry powder if you're short. Now, I haven't made any attempt to disentangle periods of market overvaluation with that of the industry. And most historical narratives of bubbles, like in the 1920s and the 1990s, suggest that the two are intertwined. You can't really separate them. Like we think of the dot-com period as being a hot NASDAQ market and a hot market overall, but also very focused on that particular sector. In the data, average market returns post-industry run-up are poor. So the average excess return is minus 3% in the first year, which suggests that part of what I'm picking up here is kind of a market overvaluation indicator. In other words, when you see industries doing incredibly well and a lot of speculative activity, that should make you worry at least a little bit about the state of the overall market. International data, I'm just going to flash this picture up. It should look almost identical to the US data, and that's because it basically is. Again, it's not completely independent. For example, just to give you a sense, we pick up dot-com price run-ups in the international data in the 1990s as well. Obviously, those aren't completely distinct from the ones that are happening in the United States. So second finding, price run-ups are associated with a high likelihood of crashes. We define a crash as a 40% drawdown experienced over the next 2 years. Here is the kernel density, which is basically like, it's sort of a smoothed way of looking at the average probability of an event conditional on what's happened before. And so here we're looking at the past net of market return, 0%, 50%, 100%, and the probability of a crash within the next 24 months. You can see that when you condition on a high price run-up, that probability increases pretty dramatically. Now again, those of you who are quantitatively minded in the room, you might say, aha, but hasn't the volatility gone up? And the answer is, yes, the volatility has gone up, but not enough to explain the increase in probability of a crash. This, I think, is an even cooler picture. This is showing the kernel density of excess returns post-market run-up. So what does this mean? Typically, when we look at the returns of an industry or the market, we expect to see what? The bell curve, right? And in fact, if you look at the unconditional distribution of returns for an industry, they do look like a bell curve. They're right there. Now what I'm showing you here is the conditional distribution based on a price run-up. And you can see two things. One is it's kind of wider, right? So vol is higher. I think more interestingly, there's kind of a bunch of weight on the left tail. Again, all of this is picking up the possibility that a crash is imminent. I think there are some questions when you do this kind of analysis, how much of this is driven by an increase in volatility. But by the way, it's quite interesting to think of, even if part of it is volatility, it's quite interesting to think that the price run-up is informative about the future volatility of the industry. Here are the statistics. I mentioned that we're doing this based on 100% price run-up as a criteria. Of course, you can pick any run-up criteria you want. Here I'm showing it to you for 50%, 75%, 100%, and so on. I already showed you in pictures the 100% stuff, so I'm just going to emphasize this one on 150%. So if you set your threshold at 150%, you get even fewer episodes of price run-up, as you might expect, right? This is a very high threshold for calling something a bubble. Okay? In fact, we only identify 15 in the entire series. Okay? So this is really getting close to HBS case method style. And of those, 12 crash, so 80% of them crash and experience pretty significant drawdowns. When you condition on a very high past return, then I would want to go back and correct what I said earlier about average returns, and I'm going to show you that here, which is that the average returns for these very, very high price run-ups do tend to be significantly negative. Now, here, I think when even using the word significant is tricky because it is such a small sample, but using conventional statistical techniques, there's statistically negative returns. The third and fourth findings are that conditional on a price run-up, crashes and non-crashes differ in their characteristics. So what does this mean? We're going to collect a bunch of characteristics of the firms that are involved in the price run-up. We're not going to try to reinvent the wheel here. We're basically going to look at characteristics that people in asset pricing have studied over generations. So just things like issuance, book to market, all that kind of stuff. We're a little bit limited in what we can do here, frankly, because we got to be able to do this back to the 1920s. Okay? So for example, you can measure book to market ratio back to the 1920s. Some other things that you, for example, suppose you wanted to measure news content or something like that, that wouldn't be possible, or at least it wasn't possible for us at the time when we were doing this. There are some data issues when you do this analysis. So for example, volume in the 1920s isn't really comparable to volume in the 1990s or 2000s. So you do have to think pretty carefully about how one might scale the data so that you can make these episodes comparable in some way. So what do we look at? We look at vol, turnover, age tilt. Age tilt is basically saying how much of the price run-up came because the younger firms in the industry went up versus the firms on average went up. Issuance, book-to-market ratio, the cyclically adjusted PE ratio, sales growth as a measure of fundamentals, and then acceleration, which is, as the gentleman in front of me said, is the second derivative. It's really showing the convexity of the price path. When things that are, have a high acceleration, it's because they're running up like this versus running up like that. Basically, what we do here is, it's a little bit tricky to see on the picture, but we're just comparing the episodes that crash versus the episodes that don't. And we're looking here to see is there any statistically significant difference between those episodes in terms of those characteristics. In other words, is it true that the episodes in which there was a crash, the firms were younger? Okay, that's a test that you can run. Okay, that seems to be true in the data, just as an example. So when you look at this, you can also run a joint F statistic, which is to say you're going to look at all of these characteristics jointly. It suggests that there are multiple characteristics that are different across these events. You can do the same thing in the international data, and you can, of course, do the same F-stat. And you find that several of these characteristics are predictive. Similarly, you can do the same exercise. It's really similar exercise in spirit. You can predict returns. So you can use those same characteristics to say, OK, can I predict what's going to happen to the industry over the next 24 months? And you could essentially do the same type of analysis in a regression form. And you find exactly what you would have predicted from the table that I just showed you, to the extent that you can say, well, one of them is going to crash versus not crash. That's also helping you forecast the return. Last point. I think when you do an exercise like this, you have to think pretty hard about statistical significance and data mining. So again, quiz for the audience. Suppose that I set my statistical significance threshold for 10%. Okay, 10% significance level. And suppose I look at 10 random characteristics. What do I expect? Even if there's nothing in the data, what do I expect to happen? You expect one of them to show up as significant, right? It's the definition of the significance level. Okay? So you gotta worry when you're doing this kind of analysis that I'm just poring over lots of different data and I'm just showing you the stuff that's significant. Now, I didn't do that, but you don't have to believe me, because what we do in the paper is we actually show plenty of things that are not significant, and we actually try to show basically everything that we can do given the data that we have. I'm not sure that that's a super compelling response. There's actually, it turns out this is a well thought of problem in statistics. So that same logic where I said, okay, suppose your threshold is a 10% significance level. Well, you expect one thing to be significant. Well, suppose then you find 5 things that are that pass the threshold. Well, you say, wow, geez, you probably found something. So there's a procedure that essentially does that, and it essentially allows you to, it's called the Benjaminian-Huckberg procedure, and it allows you to essentially correct for this problem of false discovery when you're doing multiple hypothesis testing. We do some work in the paper also to look at trading strategies. I think you could see exactly where that's heading. It's essentially showing the same results about predictability, but actually just kind of implementing that predictability in the form of a trading strategy. Now, the one thing that we learned when we were doing the trading strategies is that the timing is pretty tricky. The other thing that we learned is that there's this trade-off, it's probably obvious now that I say it, but it wasn't obvious to us when we were doing the work, between false positives and false negatives, which is to say, you can set very high thresholds for calling a bubble, and that's going to mean that you're going to tend to be right when you call it a bubble. But of course, you're going to reduce those false positives at the expense of more false negatives, which is to say you're sort of making less calls in the other cases. And so I think that's a general thing when you're thinking about bubbles and you're trying to think about how you might design a trading strategy around them. But it was particularly true in this case when you have such limited data. So with that, I'll just end. We think Fama has set a bar for identifying bubbles. I think personally, I can say I understand the hostility towards the term bubble and the reason why we want to try to impose a bit of science on the usage of that term. That said, I think we do have some preliminary evidence in the paper to say that you can at least potentially call a bubble. But, I think there are ways that you can raise this bar further, and I think we have to be mindful of the limitations of the kind of research where you have 40 observations to draw your conclusions. So with that, I'll hand it to Matt. Thank you.
So I'd like to thanks for the invite. In finance, the idea of bubbles is provocative, and as Robin said, it's been pretty elusive in the literature. I've done a little bit of it in the past. It was kind of fun to kind of re-look at it. Robin did a good job of highlighting his results, so I won't go through that. Just that there were a few clever things in the paper, I think, especially. I think the idea of conditioning on raw and net of market is kind of a good idea. Trying to extract as much out of the data as possible, going to industries and international. And then also it was discussed at the end, looking at conditional on what I call a B, a bubble, a run-up, and then breaking it up into the crashes, non-crashes, and trying to see what's unique about each of those two things is a sensible thing to do. So this discussion, I'm going to anecdotally talk about, is B really a bubble? Then most of it's going to talk about, is C really a crash? Or that's the maximum 40% drawdown in the subsequent 2-year period. I'm going to give an alternative fact. I don't mean Kellyanne Conway style. I mean actually a true alternative fact. She's given kind of alternative facts a bad name. So I'm going to try and lay that out. And I'm going to make one comment at the end briefly about the issue of sample size. The paper starts with this quote from Fama, and Robin also in his first slide had this quote, which was basically Fama saying, hey, I don't see, it's not a bubble unless you can kind of describe when it ends. This paper obviously lays out an argument that it, as Robin said, it reaches this hurdle. I'm going to give an alternative interpretation of the evidence that suggests maybe it doesn't. That said, people in glass houses shouldn't throw stones. Historically, I have written about bubbles, and I fall into the Fama, let's say, trap. Don't take my word for it. You could actually go back to the New York Post. This is December 23rd, 2001, and I'll just read it quickly. It's called "Thanks for Nothing, You NBR Brains." Those O'Connor wonks at the NBR are at it again. In November, the venerable group of economists descended from the ivory tower to declare what everyone not in a coma already knew, that the US was in recession. Now, more than a year since the dot-coms bombed, driving down stocks as much as 70% and closing the door on the longest US expansion, the NBR's academics put their frontal lobes together. Don't you love the way the New York Post writes? To explain why the bubble burst. It's possible that optimistic investors overwhelmed pessimistic ones, leading to stock prices not reflecting fundamental values, says Eli Ofek and myself. So I have certainly been subject to this criticism before. So here is like some of the well-known, two of the really historical bubbles, tulips and South Sea. Then more recently, the Nikkei maybe, the dot-com bubble I wrote about a couple of years ago in China, and then of course Bitcoin. When you look at the picture of all of these, wow, they look identical, don't they? From South Sea to Nikkei to dot-com, they all have that little shape. Fama would say, you know, it's because you're focusing on the peak, right? We're focusing on that peak. It's not surprising they have the same shape. It's really about predicting where that peak is. Maybe November 25th in the tulip mania, that was where we thought the bubble was. So that's sort of the criticism of bubbles. Now I'll say in my defense, in the dot-com stuff, we did try and argue when the peak would end. But nevertheless, that's a common criticism. The unique thing about this paper, which is what Robin talked about, they try and pick an ex-ante view. And what they pick as their ex-ante view is they say, look, let's take the last 2 years. If the last 2 years has had this huge run-up in prices, we're going to call that a potential bubble. But the question is, if you've had a run-up in the last 2 years, you know, is that a bubble, or maybe that's just a lot of good news? So here's an anecdotal example. This is it's an individual stock. It's not an industry, so I'm cheating a little bit. I picked the individual stocks that want a lot of volatility, which I'll come to a little bit later. So 1999, big run-up, satisfies the B, the bubble, and then that's that thing in purple, that's the 2 years, and then there's a crash. A few years later, 2005, satisfies the run-up. That's the thing in circle. Went up a little bit more, then it had a maximum drawdown, satisfies a crash. A few years later after that, has a run-up as well, satisfying the bubble. Didn't satisfy the 40% maximum drawdown, but got pretty close. And then just actually, as of a month ago, it had also gone through another run-up. So this stock has hit 4 bubbles and maybe 2 to 3 crashes, or is it maybe just a lot of variance in the fundamental news that's coming out about this stock? So that's the question. By the way, this stock's ticker symbol is AAPL, which of course is Apple. So to this point, what's a crash? So in this paper, they choose a 40% maximum drawdown over the 2-year period, conditional on the run-up. So I said to myself, what would you expect the maximum drawdown to be? So you can actually take the simplest model in finance, the random walk model of stock prices. So assume stock prices follow Brownian motion. They can have a mean, a drift mu, and a volatility parameter sigma, and you can actually calculate the expected drawdown, the maximum drawdown from that model. It's a complex formula. It's not closed form when you have a non-zero drift. But with a zero drift, it's actually sigma times square root of pi times t over 2. In this paper, t is 2 years. So it's sigma times square root of pi. Square root of pi is about 1.8. So it's 1.8 sigma is the expected drawdown. Median industry sigma is about 26%. Net of market would be a good zero drift assumption. That's about 20%. So you're talking about the expected 2-year drawdown in this continuous time model is actually around 40%. So it's not really a crash. It's something you might expect in the data. And even with the drift that's in the industry returns, so it has a Sharpe ratio of about 0.4, the expected max drawdown is about 33%. So this is the theory. You could actually go ahead and simulate that same data using discrete time data rather than continuous time data, using monthly returns, and you get out some results. First of all, the expected value of the drawdown is linear in sigma, which is what you had from the theory. And it's also, it turns out to be almost linear in the probability of a max drawdown as well. And the numbers are a little bit less because they're continuous versus discrete time, but they're in the same ballpark, the same zip code. So that tells you that this expected max drawdown, just like we saw with Apple, is perhaps not that surprising. So here's the alternative fact. So I took the Fama French industry returns from their website. So Robin said they actually construct the industry returns themselves because they're using new firms coming in. So the results are going to be a little bit different, but they look actually pretty similar. So this is the industry returns. You use the same conditioning on the price run-up. And what you see is, oh, lo and behold, the bigger the price run-up, which is on the x-axis, you have the higher probability of a crash. This is true of raw returns and true of net of market. And that's their figure 3 in their paper. So that's true. However, what's also true is if you condition on rundowns, so if I condition not just on the bubble, I condition instead on big rundowns over the past 2 years, so in some sense crashes in those industries over the past 2 years, you also see a much higher probability of a crash, a much either both net and market. So it's U-shaped. So the pattern is very similar for minus B as it is for B. Also, if you looked at figure 1 in the paper, the figure on the left-hand side is after a run-up, you get this, by construction, this bifurcation of positive and returns and crashes on average around 0. You can do the same analysis for the rundowns, conditioning on a rundown using the same criteria, which we used like a 40% fall over the past 2 years, and you also find a very similar shape in returns. So it looks like the pre-run-up and the pre-rundown look like they have pretty similar characteristics. So what could be going on? Well, we saw that theoretically the expected drawdown and the probability of a drawdown, the max, is linear in sigma. And in fact, more generally, if you had a more complex model with jumps, it would also depend on higher order tails. So maybe those big run-ups or rundowns are just ways of capturing the changing conditional distribution of that industry, whether it's a large sigma or a large higher order moment. My first class I took at Stanford, Empirical Finance, taught by Mike Gibbons up here, first paper we studied was a paper by Blattberg and Genides that talked about unconditional versus conditional distributions, written in like the 70s. I'm not that old, but it was written in the 70s. And that's maybe what we're capturing here, is we're really just capturing that the conditional moments are changing over time and changing across industries, and the big run-up and big run-down is picking up that feature of the data. And so maybe this is why you get the C probability for both B and minus B, just like we got for Apple earlier. Not sure it's necessarily about Fama's bubbles. It might just be a little bit about what's going on with that industry. That's an alternative viewpoint. Final comment about sample size. As Robin said, he knows it, we don't have a ton of data, right? So you got 85 years of industry data per industry. That's about 45 non-overlapping 2-year periods. And now you're looking for a big run-up. Maybe you're lucky. Maybe you get 1 per sample. But now we have 48 industries. So that gives us a little bit more information. But those industries are correlated. The median correlation is 55%. Net of market is 10%. If you were looking at the correlation of returns and trying to document information about returns, and you went from 1 to 48 industries with those correlations, you don't get 48 times the data. You get quite a bit less. Who knows what happens in the tails? But you probably, theoretically, could show you'd get maybe 16 to 24. So 1/3 to 1/2 the information with these type of correlation patterns. So let's say that 48 is more like they have 20 independent observations in the data. And in fact, if you go to their paper, they go through they describe each event, and you'll see there's a bunch of events which do in fact cluster. Different types of software clusters in 1999. There's things that cluster in the 1920s. So probably 20 is about right. So if you have 20 observations, now we're going to separate them into crashes and non-crashes. Forgetting my comment just a second ago about whether it's a crash or not. Let's suppose it is. Now you have 10 crashes, 10 non-crashes. So I like the cleverness of this idea, But I think we have to be a little bit careful. We look at multiple characteristics, turnover, volatility, age, issuance, many different fundamentals. You have two sets of 10 events. You're taking all these characteristics and you're trying to sort those, almost no data to separate them out. We can use whatever magical standard error procedure we want to, but we can't change the fact we only have 10 observations on either side. So that might suggest the standard error properties may have some issues in small samples. Like, to be frank, most of these standard error procedures have issues with them.
We'll take questions starting with Veneer Bonsali in the front.
There is a whole strand of literature that Didier Sornet and his team have worked on fitting log periodic oscillation, and they have a dynamical model that actually talks about interaction between traders and how serial autocorrelation results in these crashes. There's a huge amount of literature that actually fit it to stock markets, to bond markets, to equity, to currencies, and they show some degree of predictability. And they've actually written a book called Why Stock Markets Crash, and they have a lab in Zurich that actually takes these characteristic signals, very statistical, in the same spirit as you guys.
People have looked at a lot of related statistical issues. Actually, there's I believe it's a Schwartz paper that looks at some of the issues that are related to what Matt raised about the conditional distribution based on past price run-ups. We became aware of some of this stuff. Some of that we incorporated when we learned about it. Some of it we ultimately deemed to not be relevant. But that's always whenever you tackle a topic like this, you hope that you can circulate it and that people can tell you that if you're missing something.
Yeah, that's in part why the center exists.
That's an inevitable problem in all sciences. I actually think finance and economics is better than most sciences in this dimension because everything is out there on the internet. And that's also why we go out and present and we try to have people alert us to what's relevant.
Your research was very focused and bottom up. So did you think about shifts in a macroeconomic cycle and how that translates into more micro and that causes the bubble and the crash? Like economic policy, balance of payments and things which are external, which pushes a certain industry in that direction?
It's a great question. Let me just rephrase for the audience. I think the question is, we looked at a lot of things that were kind of industry specific as predictors, but could you have imagined doing this at a more macro level? So for example, if the Fed lowered rates 2 years ago and there's a price run up, is that more likely to be a bubble than if the Fed did not lower rates? Just to give you an example. Okay. We thought about that. In fact, we do use one macro variable, which is the CAPE, the overall price level in the market. If you're concerned about some of the issues that Matt raised, which I think are real issues, and I certainly wouldn't want you to dismiss them, those are going to loom even larger if I'm now combining my data with just pure time series data. So the amount of power I'm going to have is going to be dramatically reduced. At least things like issuance, I'm going to be able to compute that at the individual episode level, right? But now, because I have episodes that are clustered and my explanatory variable is going to be identical across those clusters, I really have less that I can say using that data. But it's something that, in principle, one should do, and it's a great set of questions.
Are there any bubbles currently that either of you have discerned through the definitions you've used?
We actually have this map that we now do it globally. So for 12 sectors in 30 countries, we're academics, so I don't update it every day. We update it every 4 or 5 months, and we also have a data lag. But you can scroll through the map, and it basically has some of the indicators on there. It does it country by country. It's not doing exactly what we do in the paper. Because we're running logistic regressions, so we're sort of essentially trying to predict a drawdown using all of the data that's available to us, but it's capturing the same spirit.
Talking sector, I thought in your presentation.
Country sector.
But in your presentation, didn't you suggest industry double the market or double absolute gains? Are there any currently?
I don't believe there are any sectors that qualify under those criteria right now. However, if you do a logistic regression and capture basically the spirit of our exercise, meaning a combination of price run-up with some other features, it basically will help you flag some kind of potentially problematic areas. Sorry.
I teach a course on the Chinese financial markets at NYU. And in January, I do one topic on sort of, it's an intensive course, it goes from 9 to 5, 9 a.m. to 5 p.m. And I was teaching a course on the Chinese stock market, and so I talked a little bit about bubbles. So even though I've taken a little bit of alternative view to Robin, I talked about bubbles in that context, and I asked the class, I go, how many of you, you're in one right now probably, how many of you own Bitcoin? And no one put their hand up, and I'm like, look, my wife's nephew, I was 14, owns this stuff. So they all, most of them put their hand up. And I said, it's looking pretty bubbly. That was at 9:30 a.m. on a Wednesday. By 4 p.m., it had fallen 30%. So I came back to my class and go, did you listen to me? So that would be a bubble. The Bitcoin would fit into that.
So Bitcoin's really interesting because Bitcoin, the parallels to the episodes that I showed you here are uncanny. So you have a lot of stuff we can't measure, but if you try to compare .com in terms of just not the price action, but all the other things that were happening, adding .com to your name. Do you remember that was a big thing? Right, so 70 companies did that, and the average price appreciation post adding .com to your name was like 60%, something like that. So now if you add blockchain, if you're a blockchain company, price pops. You had a lot of issuance in .com. In fact, Matt wrote did a lot of the work trying to quantify stuff that was going on at that time. You can just go one after the other, and the parallels are striking.
I feel like there's sort of a step zero here, where you're deciding to look at things at the industry level, 49. It seems like that step zero is to think about whether you're trying to predict a market-wide event or an industry event. And just wondering if you had any thoughts about that, because of the different experience we see, like a dot-com bubble versus the financial crisis. And
so I didn't show it in the paper. We actually did some exercises along those lines. You can actually do a market return forecasting exercise. So, for example, you say, suppose I want, in the same spirit of the presentations earlier today, where you're trying to forecast the return over the next year or two. Instead of using the CAPE, you use, are there any bubble indicators right now in any industries? And if suppose you use that indicator variable, that actually works reasonably well. Again, it's subject to the same critiques that one has when you're doing time series regressions, and so you should take that with a tablespoon of salt, but it is. That's there in the data.
Anecdotally, what you always hear is that markets or something is going up with the stairs and then down the elevator. And in what you were showing, and perhaps I missed something, but you mentioned that you were looking at the rate of increase.
Yeah.
I guess I would just have anticipated that the rate of decline then would have been more rapid than the rate of increase. Is that anything that you looked at or were surprised yourself?
We didn't study that. It's interesting that you say that, because that is a graphical intuition that many of us have about markets. Actually, I don't know that we would be able to relate that graphical intuition to theory about. We think when there's information that comes out, it should show up in the price right away. We don't think of that as like happening over some time.
So
right?
I guess also these days with HFTs and with, you've got a bunch of stop set or something, there are a lot of amplifiers in price movement. And I would anticipate that would even be more so the case than in previous, although the most dramatic decline I saw of the pictures that you had put up was the tulip bubble, which was, I guess, the oldest one. So
when you do look at bubbles, one common theme is that short sale constraints are a big part of it. And so most of kind of the bubble bursts, if you believe there are bubbles, like the .com, we argued it was the expiration of lockups. With China, it was a forced sales because they changed the leverage rules.
So they had a structural reason for being
even
there to start with.
Bitcoin, you could argue the introduction of futures. So your intuition is correct in that sense, that if there was a relaxation all of a sudden, you would get this rapid. Even though I just gave an anti-bubble discussion, that would be one story, I think.
And then just a real quick question, why 2 years?
To discipline the analysis. Because if you allow yourself too long, it's just too easy to call anything a bubble. Like one of the things we did was said, it's got to be true that our ex-ante screens pick up 1929 and .com. If they don't, we've obviously done this exercise incorrectly, right? And they do that. And then we made a bunch of other decisions along the way. Some of it we did some robustness on, but others, we definitely haven't. And I think that would be a reasonable exercise.
One other question, which is a bit unfair, I guess, is why not commodities? I mean, if that's we think about bubbles, we go right to the tulip case. Why not look at commodities? And we get rid of the co-movement issue. Then it's unfair because it's probably there for you to do or for someone else to do. But we have 1,000 years of data.
Well, we wanted to start with, our initial concept when we were doing the paper is, let's look at all the other things, the characteristics. And that was going to be the whole focus of the paper, rather than just the pure distributional points that we've been debating a little here with Matt. And it turned out measuring those characteristics is, as I mentioned, quite challenging. I think that would be even more challenging once you start looking at a bunch of commodities markets. Suppose you wanted to measure volume, issuance, mining. I mean, start your list. That's going to be very challenging to do.
Have you considered inputting in your model the use of technology like machine learning and the use of big data? Because some researchers have warned that when everything is going up, it will go up consistently because everybody is buying. But when everything is going down, related to bubbles and crises, that will be exacerbated because the machines will be, selling more rapidly.
The paper is actually the opposite of big data. It's small data. It's kind of closer to case study. There's a question, I think, about whether technology changes any of this stuff. I mean, I'm not sure I have a view on that.
Because you said that you were using data on the US, but also in other markets globally, and commodities. So, commodities, you cannot use small data.
The reason that we've tried to keep this, the analysis relatively simple, because, frankly, many of the issues that Matt raised, which is, even though we've tried to be transparent, there's these issues of data mining and how many observations do we really have, and so on. And so I think if we go down the route of now using machine learning and so on, and it's going to be a lot of smoke and mirrors, and it's really, I'm not sure it's going to be more persuasive for folks.
There's not enough data to do nonlinear type methodologies here, really.
Robin, you said early on that perhaps the paper should have been called Fama Schiller. I'm wondering if maybe it should have been called Fisher Black, because in noise he talked about prices being within plus 100 and minus 50%. And when you showed the analysis of various run-ups, anything up to 100%, the subsequent drift was flat. But when you went higher, 125, 150, there was a significant reversion. So I'm wondering if you'd consider doing the same thing with looking at drops more than 50% and seeing if, again, there's a reversion.
Yeah, we just didn't look at the recoveries in the data. But yeah, we should look at the Fisher Black stuff. Can I respond to one question that you had? I just wanted to say I thought it was a terrific discussion, and a lot of those issues are issues that we have thought about when we were writing this paper. The one place where I would quibble a little, and I would say our disagreement may be more semantic than anything, is to say that if price run-ups dramatically change the conditional distribution of returns, I think that's interesting and we should know about it. So if for example, the prices run up and all of a sudden I'm either sitting on a lottery ticket or a real stinker, that's useful to know. And if I couldn't have predicted that from the volatility alone, I think that's it's a useful lens. Now, I agree, maybe we would have chosen different words to describe that. You might have called that conditional vol or conditional skewness or kurtosis, and I might have called that a potential bubble indicator.
No, I agree that if you look at the run-up or the run-down, it's obviously telling you a lot about the conditional distribution. Yeah. And the point was that the run-down's also telling you something kind of similar. So that may be a clue to what might be going on with the with those industries.